Hey gang, welcome to Time in the Market, the 27th best investing channel in the tri-state area on YouTube. Thank you for joining me again. Thank you for all the likes and subscribes that you guys have given me. We're back again with another SPAC video. Today we are talking Supergroup going public via ticker SEAH. This is another SPAC, Sports Entertainment Acquisition Corp. This one is in the gambling realm, which is something that I think has been a good investment for a lot of people. Let's say you invested in DraftKings or you invested in Flutter or one of these other gambling companies. It's really becoming a bigger investment thesis, especially in the United States. C is taking Supergroup public. Supergroup is more of a global player right now. They're only just entering the American space. So I did some analysis of some other companies in this space. I'm looking at 888 Holdings, which is a pretty good comparable. This is online only games. Then you've got Flutter, which is online and offline. So not really the best comparable, but it's close enough. People are enjoying this as an investment vehicle, this being gambling, because it's got a lot of growth potential in the United States. The legal hurdles have been kind of crossed in a lot of states, and more states are open to essentially sports gambling and online casino games, etc., which is where companies like Supergroup shine. So I'll be interested to see how this one looks. I do have warrants of SEH that I've had forever. I like the team, so I bought this pretty close to launch. I don't remember when it launched, but it's been a couple months. So good to see them acquire something. The response is somewhat tepid. It's up 5%, but not a huge deal in terms of the response. So it seems like the market finds the deal fair. We'll see if that's the case. I did kind of see some announcements about the deal, and at a high level it seemed okay, but we'll kind of dive into the details here. A lot of disclaimers. Please read those. Do note, I am not a qualified financial advisor. I'm just doing this for fun, so please do your own due diligence, do your own research, talk to a qualified financial advisor before you make any investments in stocks like Supergroup, SEAH. Let's see what we're doing here. You got a management team that's been in the industry for quite some time. You've got a solid management team from SEAH. I like the combination of experience in the NFL, in other teams, etc. So that's really why I was interested in this. I think this group, especially with the name it had, would be investing in a sports related field, and they've certainly done that, kind of entering the iGaming space via SEAH, right? So you've got a leading position in sports and entertainment or a related technology and media subsector. That's kind of what they were looking for, with long-term prospects, whether it's organic or through acquisition. Would benefit from the networks that SEAH brings, right? There is a lot of network effect to some of these iGaming companies. They have to enter new markets. They have to expand. They have to have certain marketing spends that allow them to gain new customers. That's really what it's about. It's about gaining new customers, not churning them over. And again, a company that would benefit from being a public company, which is what it's happening here. So you've got a dual offering. And this is a claim that they're uniquely positioned in the gaming universe. That's worldwide reach and scale. I think a lot of companies are getting there now. They have worldwide reach and scale. If you kind of look at the two companies I'm comparing against, they have that dual offering. They've got a high growth Betway, which is their sports gaming side, and then they cash generative Spin, which is their iCasino side. A lot of other companies have the same thing, whether it's casino games or poker games or whatever. Digital DNA, proprietary data, science and technology, etc., and high growth and profitable. I think you can see that in a lot of other companies. This isn't unique to Supergroup, right? This is a good margin business, right? Once you kind of get into a market, you can get a decent margin from the revenue you're generating from the people who are gambling using your proprietary software and data. What it comes down to is who can use their data better to make sure that they're acquiring customers in a cost accretive fashion and also monetizing it well. And that kind of goes back to one of the other videos I covered recently in Vivid Seats. It's like all of these apps are kind of similar, right? All of these apps are vaguely doing the same thing, right? At the end of the day, you're betting $2 here and you're sort of getting similar odds across a lot of these apps. It's, which apps have a better user experience, which apps have better / lower costs of acquisition, and which apps can kind of transfer some of these dual offerings that they have to maybe move some people who are on Betway onto Spin, or move some people who are on Spin onto Betway, etc. And it'll come down to which of these companies can effectively move into the United States market, because that's really the next growth area for a lot of these global gambling corporations, which there are plenty of worldwide. There aren't too many that are specifically targeting the United States, because the United States market is so new, right? It basically just happened around 2018, where it was legalized. So it's certainly a growth opportunity for a lot of these companies, but also a competitive space, because you're certainly going to have, 5 to 10 corporations that are vying for entry into a competitive market. And there's certainly going to be a lot of gambling in the United States. The United States is a country that loves their gambling. A lot of my friends gamble offline before this was even legal through bookies that they knew. I personally don't gamble myself, but this is a thing that I know exists, and I think this is a thing that is going to be very profitable for a lot of corporations, and Supergroup is potentially well positioned to take advantage of that as well. So what's the deal look like? It's kind of an odd structure. There's no pipe, which is a good thing or a bad thing. I mean, it sort of seems like they feel like they can fund the acquisition without the need of a pipe, which is good. That means that the public shareholders get a bit more than they would if a pipe was involved, if the valuation was the same. The other thing is, hey, did they not want to raise a pipe, or were they not able to raise a pipe because there wasn't much interest in the valuation? That's one thing to think about. I don't think that's merits anything negative about the company, that there's no pipe, but a pipe gives you more of validity to the investment, because some people are interested in putting additional money towards the investment at this valuation. 70% of the Supergroup shareholders by value will retain 100% of their respective pre-transaction stakes. That means that some people are exiting. That's not the best sign that people are selling at these prices. Looks like there's about 465 million in cash that is being used to selling shareholders. So basically, they're getting 450 million cash in trust from the SPAC in order to take this public, and most of that money goes towards the selling shareholders, which isn't the best thing. I typically like to see a lot of this cash just go straight to the balance sheet, but over here you have some of this cash going towards the selling shareholders, and also some of the existing balance sheet cash going towards not only the selling shareholders, but the SPAC sponsors and the transaction expenses. So end of day, this is a business that starts with 300 million in cash before the transaction, before they go public, and ends with 205 million in cash after the transaction, because a couple of, less than 30% of the people are exiting their stake in the company, which from a deal structure perspective, not the best. But, maybe some people wanted to exit. Doesn't necessarily mean it is a bad deal, because most of the people are retaining their shares, but it isn't structured in a way that is the best for new and current investors outside of the ones that are exiting if the valuation drops. They've got an earnout award of up to 10% of Supergroup rollover equity to be granted to Supergroup shareholders upon achievement of certain performance hurdles. I'll have to look into whether or not that's defined anywhere. What are certain performance hurdles? Whether it's revenue related, EBITDA related, or stock price related, they don't specify here. Another thing they don't specify is how many shares are actually being issued, right? It kind of seems like the valuation is at 5.1 billion, but then are shares not being issued because some of this is valued via existing balance sheet cash, and I think that's the case here. So we're talking about a 5.148 billion market cap minus 300 million in cash. So 5.148 minus 300. And then you've got, I have a little spreadsheet here that I'll share with you guys that compares some of these other companies. And then you've got 205 million in cash that remains on the balance sheet. So they are not in debt, which is good. So you've got a equity value of about 4.64 billion, which tracks with what they're showing here. So interestingly structured deal. It would have made more sense to me if they were able to get a pipe so they wouldn't have to use existing balance sheet cash to buy out the selling shareholders, right? Because at the end of the day, You're making this deal to put the company in a better position, to make it better structured to grow going forward. And I'm not 100% sure that this deal does that, because you're taking your balance sheet and making it worse, right? Potentially you have access to better public markets, etc. It can get debt at a lower price, and the balance sheet is still fine, right? There's $205 million in cash and potentially no debt, unless we see something else that shows that there's debt, which is still fine, but it's not as good as I'd like it to be, because typically what I want to see in these SPAC deals is that, hey, some of this money goes to here, more of this money goes to here. You're not taking a net negative position to your cash by making the deal, which is what's happening here because these guys are selling. But valuation 13.3x 2021 EBITDA, so we'll see how that looks. We'll kind of look at that later, but seems okay when I go back over here and I look at some of these other valuations. 888 Holdings, for example, based on their 2020 EBITDA is about 13x, 12.5x enterprise value over EBITDA. Flutter, which is, again, a different business model. They also have fantasy sports via FanDuel. They also have physical locations, like via their Patty, whatever, their Patty something business line. So I think this is a bigger business, and one that potentially is growing at a decent clip here, that has more access to different business models that may allow it to have a better valuation than some of these other online only plays. But compared to this, seems relatively in line, but we'll see how some of the other stuff looks. At least at face value, it looks like a decent deal from a valuation perspective, but we'll get more on that once we actually get to the financials. Our vision: to provide first-class entertainment to the worldwide betting and gaming communities. At the end of the day, this is a simple business model, right? You have sports betting on one side and you have online casino on the other side. Both are probably decent margin businesses. Both probably require a decent amount of spend to acquire customers, but as long as the customer churn isn't huge, they can make a lot of money off those customers once they're acquired. And both probably exist in a variety of markets at this point and are expanding into other markets as well. So key investment highlights: it's a holding company for leading online sports and gaming operators with a diversified global footprint. So again, it's a global footprint, more comparable to global investments, not so much plays like DraftKings. DraftKings is another really solid SPAC play that I do own, that I've owned for a while. It's been a very good return for anybody who invested in it. This one is really a growth play on the United States market specifically. There's no global assumption here, and this one's priced quite high at $23 billion. I think this is somewhere in the 30x price over sales. They're not actually making any money right now. Let's check out their price over sales ratio. So if you kind of look at this, right, it's basically a 30x PS price over sales. It is growing at about 50%, so very fast growth potential here. But if you look at something like this and try to compare it against Supergroup, it's probably not very comparable, because you're looking at a global player, and a global player is generally going to have lower revenue and lower revenue growth, because the global market is a bit more mature in the gambling space, and it also generates, or hypothetically will generate, less revenue per player. And that's kind of the case in a lot of businesses. The United States market is a very high revenue generating market for a lot of companies in relation to other markets. If you look at, even unrelated to this, if you look at something like Netflix, they get a lot of their money from subscriptions in the United States. They can charge $13 to $14 to $15 a month in the United States, whereas in a lot of maybe outside of Europe, in Europe they can do that as well, but in a lot of other countries where they're entering the markets, they may be charging $2 to $3 a month or something like that. So a lot more profit potential in the United States, and I think that's where the long thesis for a lot of these plays, these global plays that are entering the United States, comes in, and why some of their valuations will likely go up if they can successfully enter the United States market. So They've got 42 billion plus in wagers per year. They're in 23 licensed jurisdictions, excluding the United States. They've got 17 in-country teams offered in 26 languages, 2.5 million monthly active customers, so that's quite a lot. 40% growth from pre-2019 customers. They've got a globally recognized brand, Betway. I'm personally not familiar with it, but hey, they are not in the United States market. They have 60 plus brand partnerships. And I think brand partnerships are a big deal in the gambling space because, especially if you're talking about sports, people go to sports games, people see the advertisements at the arenas, even when they're watching it on TV. And that kind of may translate to easy customer acquisition if they're interested in gambling. They've got an entry into the United States plan, which is again, like I said, it's a very it's a very high total addressable market. When it's mature, and it's far from being mature, I think that's really where the long thesis comes here. And with all of these plays that are entering the United States, like, listen, guys, we're entering a market that's going to be huge at maturity. If we can take even 10 to 20% of this pie, we're going to be sitting pretty in terms of the amount of revenue we can generate and the amount of profit we can generate from that. And then they've got 10 US market access deals. And I think that's due to an acquisition they're making in line with this Spac merger as well. They're acquiring DGC, which already has market access deals in up to an initial 10 states. And they have a strong financial profile. So they have an estimated EBITDA of 350 million plus, strong EBITDA growth between 20 and 22. They have no debt, and they have a fully scaled employee base and long-term shareholders, right? So the 70% plus of shareholders are not selling any shares, but still, why aren't 100% of shareholders not selling any shares, right? Do the other 30% feel like this is overvaluing the deal and that this company doesn't have as much growth potential as these other guys seem to think? So typically you want to see 100% of these guys keep their shares and roll them over into the deal, more of the money flow into the balance sheet, but that's not happening here, so that's a bit of a bummer. Two brands you've got here. You've got your online casinos with robust free cash flow with potential for further upside. You've got your Betway, your online sports book. They don't have a physical sports book like some of these other players have, like Flutter does, which could be a good or bad thing depending on how the transition to online betting goes. If it's going to become fully online, obviously companies like this will benefit. If people still prefer their local sports book, not something we're familiar with in the United States, but let's say in the UK, you can just go down the street, put a wager down on a football game or whatever, and go on with your day. Not everybody uses the online sports book like they do more so here. And this is a profitable and high growth sports betting offering. So they've got a 1.5 billion projected net gaming revenue, 350 million plus estimated 2021 EBITDA. Again, blah, blah, blah. We're talking about a pretty low average bet size. I wonder if any data in any of these annual presentations is available as to how much bet size. I don't know. It'd be interesting to see what the average bet size is for a United States company versus a worldwide company, but I don't think I can get that data right now without doing a lot more research, but that's something to keep in mind. Again, if the average bet size goes up, the potential for profitability goes up. They got a unique operational advantage. It's stuff like this. I'm kind of like, whatever. All of these companies have their own data and analytics. All of these companies are going to say that they have the best sponsorship, the best marketing, the best lower acquisition cost. At the end of the day, this stuff will come down and be shown in the financials. If these guys actually have this and they are better at increasing retention, decreasing churn, having a better customer experience, acquiring customers at a lower cost, having better marketing and sponsorships, that will show up in the financials and that will show up in the valuation. And that's not something you can kind of effectively know ahead of time. You have to let the thesis play out and see what happens and see how the financials look. They have an established global footprint. They are in the Americas. Half of their revenue is in the Americas, not including the United States. 21% is in Europe, 18% is in the rest of the world, 12% is in Africa. What I like about gambling and iGambling in particular as an investment is that it is a good representation of an investment that allows you to benefit from up and coming economies, right? It's hard to, for example, invest in Africa right now. But if these guys have an established footprint in certain African countries and they are benefiting from growth in those economies and the uptick in gambling in those economies, then you have a little bit of an investment in an up and coming geography that you might not be able to get through other means. And this is a global investment at the end of the day, right? You're making an investment in the ability of the countries that they are involved in to participate in the gambling space. And that could be, gambling is kind of a tricky thing because some people love it. Some people think it's the worst evil in the world. But at the end of the day, people are going to do it. It's just making sure that they do it in a well-regulated way that doesn't harm the people who can get in trouble via gambling, right? And that's something that Betway has had some trouble with, and that's something that other companies have had some trouble with as well. For example, Betway had a 11.6 million pound gambling fine for some issues they had in terms of money laundering, accepting stolen money, and allowing people who have been flagged as customers that are at risk for losing money to continue taking deposits from them. So there's regulatory risk when it comes to some of these gambling companies. As they expand more into the United States, there's certainly going to be regulatory risk there. You can kind of look at even the Flutter. Am I looking at the right one? I am not looking at the right one. This is the Flutter. If you look at the Flutter annual report here, there's a Supreme Court fine of $870 million against one of the companies that they acquired that is currently being reheard. That's a $870 million fine for revenues of $18 million, right, in Kentucky. Basically, who knows what's going to happen? There could be lawsuits against these companies for essentially making people lose money, right? At the end of the day, gambling can become a problem for some people. And at the end of the day, these companies are sort of, in a way, expected to make sure that those people don't lose too much money. But at the end of the day, they also make a lot of their money from those problem gamblers. So there is some incentive to sort of skirt regulations and skirt the law, and that's certainly being seen in some of the fines that some of these companies have been paying for doing that. And that could be problematic if they're not doing a good job of maintaining and sticking to the regulations as set out by each individual government, right? When you look at these fines, they're not huge, but when this happened, people were upset that they didn't actually lose their license to bet in the UK, right? And if something like that ever happens, where they have some issues with any regulatory committees in any particular country or state, and they lose their license in that state, it could be a disaster for this as an investment, right? Because they're so dependent on those licenses that they have in each individual country and now in the United States. So it's an interesting business model, but not one without problems and ethical issues as well, if you care about that. Certainly you should, but at the end of the day, people are going to gamble here or there. It's just a matter of making sure that problem gamblers don't turn these situations into life-ruining situations, because it's certainly easier now than ever to gamble online, and companies like this drive that ease of use. And also companies like this have to be realistic with what they can do to problem gamblers and keep track of those problem gamblers and make sure that they're doing a good job of actually maintaining and keeping track of the regulations in the various countries and states that they work in, right? And some are easier, some are more lax than others, but I don't think the United States is going to be that lax when it comes to these regulations. And some of these lawsuits from states like Kentucky already prove some of that. And I think the United States market is going to be a harder nut to crack than some of these online gambling and casino companies think it will be. And on top of that, you've got, even within this little analysis I'm doing, you've got Supergroup, you've got Flutter, you've got 888, you've got DraftKings, and you've got other companies that are vying for each and every dollar in the iGambling space. So it's not going to be very easy to make this a sustainable marketplace for multiple companies, right? Some are going to be winners, some are going to be losers. If you kind of look at Flutter, one of the bigger companies that has 20 to, what was it? 40% of the sports betting share in the US and 20% of the US gaming share in the US, and you look at their financials, they're actually losing money. If you exclude, they're losing money in the US, right? Their EBITDA excluding the US is 1.4 billion pounds. Their EBITDA including the US is 1.2 billion pounds. So certainly some of these large companies are willing to lose money in order to acquire market share. And that's going to be problematic for some of these smaller players that are just only entering the marketplace and expecting to make this a profitable thing right off the bat. Now, it's a good thing that these guys have an online casino play that is highly profitable already. They have 34% EBITDA margin for their spin brands. Pretty solid gross gaming revenue here. Their sports betting is still a very small piece of the pie, but again, as they kind of enter new markets, as they expand into the United States, this is going to grow. It's just a matter, what's the margin going to be on this piece of the pie? If Flutter is losing money, they're a much bigger player. They already have a bigger share of the market. How much is Supergroup going to have to spend to get into play in these markets? And it's an interesting business here, because obviously you saw, hey, 2020 was a weird year, right? Stuff happened in 2020 that really impacted a lot of businesses. Didn't impact this business. People still gambled online worldwide. A lot of sports events were canceled in 2020 rather. Some were canceled in 2021. People still gambled online, right? So this is a relatively good business model they got going here, right? One that can withstand something like a pandemic. So that's really interesting to see. And as an investor, it's very enticing to say, hey, this thing did well during 2020. A lot of other companies struggled. These guys seemed like they were still making money. So hey, maybe this is something to look into. It's just a question of, is this one better than all of the other ones that are out there? They've got a couple of case studies here. Hey, we entered some markets. We started at 145K gross gaming revenue. After 24 months, we were 16.5x that with 2.3 million gross gaming revenue per month. So pretty decent increases, decent scalability here. Doesn't take super long to make some money out of these markets, but again, this is obviously one of their better results. It'd be nice to see if they have any other ones. They have another one here that started at 175K rather per month. 24 months later, they have 1.75 million. So essentially, they're saying, hey, we can start marketing in a new market, and then within 1 to 2 years, we're generating decent revenue in those markets per month. Hard to tell whether these are EBITDA positive. This is just revenue. But certainly there's some historical data that proves that they can enter new markets and generate revenue within a 12 to a 14-month period. It seems like over here, the second leg of growth here kind of slowed down. The 12-month growth rate was really the kicker. They were 8x there after 12 months, and then the second year didn't grow that much. Over here, the growth was much better in this market. You almost doubled in the second year. Over here, you maybe saw, another 20% bump. So different markets, different dynamics, different competitive landscape, etc. They are highly technologically agile. They have to be, right? They're using a lot of information to kind of make sure that they're not losing money, that everything's accurate. The data is uniform. It's responsible gambling. Again, we're talking about responsible gambling. They use their own content. They also have third-party content. We're talking about companies like Genius, which is another stock I own under Spac. Genius, which is nope, this is not the stock. It's GENI stock. NYSE. There you go. So this is another SPAC that recently merged with the Genius Sports, which basically provides data, live data feeds to gambling companies, and they certainly work with companies like Betway. I think they made a deal in 2020 sometime. So clearly, Genius Sports here is making some money from Betway, and Betway is not all internal data. They're also using third-party content and integrations to make their product offering work. And obviously that limits some of their margins as well. But in certain situations, they own their proprietary platforms themselves. So, for example, in Africa, they have a proprietary sportsbook and platform built specifically for that market. It's a localized offering that doesn't use third-party players. And then they have long-term partnerships in other areas like Europe, where they have long-term partnerships that allow them to have the technology they need to work with their products. So what are we talking about here? 7 trading margin, whatever. Okay, data. Data is constantly optimizing the customer journey. Again, I think a lot of this stuff, it's very nice. It's very fluffy. You've got right. So the idea here is going to be, how can we keep people on our platform? How can we move them around games on our platform? These, if you check out this Spin Casino game, it's got multiple games in there. It's not just, hey, this whatever game this is, but hey, can we transition some of these Spin Casino users to our betting game? Can we do it the other way around? Also, hey, how do we make sure that people are gaming responsibly? We've noticed a change in your gambling. Are you playing more than usual? Stay in control. We did it. We have made our users responsible. So sponsorships, I think sponsorships are a big deal. You know, if people see this, hey, maybe I can bet on this game using Betway. They've got a pretty decent deal with West Ham United. They are their main sponsor. They believe that the value is 5.8x based on the sponsorship cost. How they calculated that, rebased to 1x is Nielsen Sports standard for sponsorship measurements. That takes into account the quality and weight of exposure, audience size, and cost per 1,000 views. All right, sure, certainly works. Brand awareness wise, hey, they're number one in South Africa. Again, we're talking about, how do I invest in the African market? Well, there you go. You got some exposure to Africa via this brand, and if that economy is doing well and people are spending some of their money responsibly gambling, then you're in like Flynn out. I think it's Flynn actually, in the South African market via Betway. You've got a high growth market study here, where it's going to be a soon to be regulated market. They're number 2 in Brazil. Less competition, little to no marketing spend there. They're going to turbocharge growth there as well. So 2 different areas where, hey, we're already number 1 here. We've got brand awareness. We're spending money. The ROI is there. And then you've got this other market that's going to be a potential high growth market for them, where Betway rather is potentially number 2. Less competition there. They haven't really spent any money in terms of their marketing. They're going to turbocharge that so they can grow in a market like Brazil, which is certainly a high population, high potential revenue market. Profitable customer acquisition in terms of their actual customers. You went from less than 1 million in 2019 well into the 2.5 million space, so double between January 2020 and March 2021. So high growth, profitability. Their historic EBITDA trajectory is all the way up. Their historic net gaming revenue is all the way up. Are these per person or tune including January represent the line of best fit, blah, 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 blah. Individual values each month. Okay, I don't know what that graph says, but it seems useless to me. So gross gaming revenue by cohort, how are the people they acquired in 2019? Are they still playing the games? Clearly in Q4 2020, half of their revenue is people they acquired in 2020. I mean, that kind of makes sense since their growth has been turbocharged, to use a word from another slide, between 2020 and 2021. So the majority of the people on their platform, or more than half of the people on the platform, are acquired in the last year, but still 50% of their revenue is coming from people that were acquired prior to 2020. So shows some stickiness to the people that are on the platform. You'd like this number to be a bit higher, I guess, since again, 50% of the people were acquired before 2020. And at the end of the day, those people potentially should spend more money, but perhaps that's not the case. Clearly, there is still some stickiness, though, to the platform they have. Momentum driven by data, sure, fantastic. Data is central to their strategy, of course. Set deposit limits, take a break, session reminders, self-exclusion to exclude and stop gambling in terms of safe gambling, right? There's a lot of focus on safe gambling in this presentation, and I think that's key because there are going to be fines in the United States and in other countries when there are failures to actually follow these protocols that they supposedly have in place. Online marketplace is growing, whether you're talking about online casino or sports betting. Clearly, sports betting is seen as the big play going forward. It's a bigger total addressable market. Globally, it's huge. You can kind of see, hey, globally, this thing is pretty massive. There's going to be regulation of new markets. Betting is traditionally regulated first, followed by gaming. And then further, US states are going to be regulated beyond the 10 or whatever are available right now. And then, hey, people are going to have more disposable income to spend on online platforms. I mean, you can kind of see this as a similar thing to online gaming, right? A lot of people play online phone-based games, mobile games, and this is kind of an extension of that, right? Especially in the online casino space where you can bet actual money, potentially very small amounts of actual money, but still actual money. And then potentially some people who are interested in sports will transition to the sports betting side of things if you're a gambler. Personally, it's not for me. None of these things are for me. I almost never spend money on mobile stuff. But there's certainly a market for it. The addressable space is huge. As more and more people get mobile phones, this will benefit companies like Super Group, right? And mobile phones are certainly out there in a big way in countries like the United States and in Europe, but there's still other countries that don't have high mobile penetration. And as that happens throughout time, more and more people will have access to these apps, and that will only benefit companies like Super Group. And they're poised for significant future growth, right? There's markets that are not really in play right now. There's the United States, massive addressable market space, right? There's Brazil, relatively small, but still there. Australia, decently sized based on their population. But really, you can kind of see why some of these companies that are already a big player in the United States have valuations where they are, because the addressable market and the amount of money the United States will spend in relation to other countries with even similar populations, right? Brazil has a 211 million population, and the online addressable market is so much smaller than the United States. This is key in a lot of industries, and it's especially key in the gambling space, where if you can enter a market like the United States and you can do well in it and you can build brand awareness in it, then you'll do very well. And that's why you can see companies like Flutter, which already has a decent presence in the United States, have a valuation that's more than double, or almost, slightly more than double 888 Holdings, which is only entering the United States now. And you can kind of see there's data here on some of these markets that I put down. Their revenue in the United States is certainly growing, but it's still less than 10% of the pie. These guys' revenue is 15% of the pie, and they have a decent amount of market share already, right? So the amount of revenue that Flutter has made in the United States, this is in pounds, so it's closer to $1 billion in annual revenue. And this is not pro forma, so it doesn't account for the merger they recently made, is more than the overall revenue of 888 markets just in the United States alone, right? So there's certainly a huge opportunity in the US, right? This is a market that didn't exist 2 years ago and now makes up a significant portion of the revenue of a company like Flutter. And then you've got 888 markets, which is seeing their best growth year over year in the United States and the Americas versus any other country. So certainly a lot of opportunities here, a lot of growth potential for a lot of these companies that are only entering the United States market now. If they can replicate that success in growth markets such as the US, what a good transition. So How does the supergroup do this? Well, they've executed a binding definitive agreement to acquire DGC, subject to regulatory approvals. DGC is already licensed in multiple states and is applying for licenses in others. So they've got access to Colorado, Iowa, Indiana, Pennsylvania, New Jersey, applying or secured access in states that are to be regulated, like Ohio, Missouri, Kansas, Mississippi, Louisiana. So a lot of potential here. Assuming this deal passes, I don't see why it wouldn't, but there's certainly some risk if it doesn't. But clearly they're really excited to enter the United States market, and that's going to be their growth opportunity. If they can do well in the US, then you can see this multiple expand and kind of approach some of these other players that are already having some success in the US. They have, global awareness. They've already made key partnerships with a lot of tier 1 sports teams. I think this is very important. They are aware of what it takes to do well in a new market, right? You can kind of see, hey, they have a deal with 3 really good NBA teams. The Golden State Warriors may not be in the finals this year, but Steph Curry has lightened up the world. The Brooklyn Nets and Clippers are title contenders. If either of these teams makes it deep into the playoffs, even to the NBA finals, you might see some Betway branding on the side of the courts, and that's only going to mean good things for brand awareness for a company like Supergroup. So clearly they know what they're doing in terms of building brand awareness, partnering with the right teams. I think the access that SEAH Sports Entertainment Acquisition Corp might give them to, the NFL, for example, will be another big boost for them. But this is really where the thesis comes into play. Like, if this is going to be a successful investment for anybody in the long term, they have to do well in the United States, right? The global marketplace is there already, but it's a lot smaller than the United States. And the United States is really the next big up and coming market. And it's the reason why companies like DraftKings are priced at 30x revenue, right? Because they have this starting point. They're the official partner of the NFL, etc. They've made good deals. They have revenue growth in the 50% plus range, and projected revenue growth in that realm for the next couple of years. So you're talking about a really solid company that's being priced as if it's going to grow that way. But now you've got all these other competitors jumping into the space, whether it's Flutter, which is already there, whether it's 888 Holding, whether it's Supergroup via Betway. This is going to become a competitive landscape, right? So as a DraftKings investor, looking at this investor presentation makes me a bit worried because there's going to be competition. This is a global space that's already profitable, and now the United States market is coming into play, and it's potentially going to be the biggest gambling market in the world if and when more of the states are regulated, and eventually it's regulated at a federal level, or all states approve it on their own. So you're talking about a massive total addressable market that is only going to grow globally, but also in the United States, and especially in the United States, right? You're talking about, pretty significant growth. Right now, it's relatively small, 4 billion, but it's going to be pretty huge in less than a decade. And whenever maturity happens, there's going to be potential for significant profit for any companies that do well in this space in breaking through the US marketplace. So that's going to be the key here. What's their financials look like? What do their financials look like? So this kind of gets us back to this handy dandy spreadsheet that we have. So in 2019, they were at 0.9 billion, 1.1 billion in 2020. So let's pop these suckers in. 900 million, 1.1 billion in 2020, 1.5 billion plus in 2021. Their EBITDA is 55 in 2019 rather, 259 in 2020. Their EBITDA margin, 23.5%. That ties. They expect that to continue year over year as they grow. Growth rates, at least based on projections in 2021, seem to be higher than Flutter and 888 Holdings, which, if true, And it's potentially true because they are just getting into the US space. If they can do that this year and start offering products in the United States in a bigger way this year, they can certainly expand their revenue. And if they can keep their similar EBITDA margin by 2021, hey, they're, if we kind of look at potential 2021 adjusted EBITDA estimates, again, assuming EBITDA margins don't change, they have pretty solid growth potential, or at least they claim to have pretty solid growth potential. Free cash flow, do they have anything about free cash flow in the presentation? Opportunities for further growth, acquire companies with high value technology stacks, acquire business to customer online casino and sports betting companies, can be large scale, highly synergistic businesses, or strategic region specific bolt-ons, just like how they acquired the US based DGC company, and enter new emerging markets. So that's really their strategy here. Like, how can we move into new emerging markets? How can we transition into a company that's more global essentially than we are today? And how can we transition the know-how that we have as a company, that Super Group has as a company, into new markets profitably and at scale? So valuation wise, let's look at their 2020 valuations in comparison to some of these other guys. Let's look at their 2021 valuation in comparison to some of these other guys over sales. So valuation slightly higher than a company like 888 Holdings based on 2020 revenues, slightly higher than a company like 888 Holdings based on 2020 EBITDA, based on 2021 sales projections. Again, these are projections from analysts for 888 Holdings and Flutter, and projections from the investor presentation for Super Group. It's kind of in the middle. It's not quite as cheap as 888 Holdings. It's not quite as expensive as Flutter. Valuation seems fair if you believe their growth potential and their ability to enter the United States market. Is 888 Holdings, is the fact that 888 Holdings valued at 2.5x sales versus 4.4x sales for Super Group concern? A little bit, right? There isn't a huge difference, at least currently, in 888 Holdings versus Super Group. Super Group has better EBITDA margins, which is a good thing. But they're sort of in the same space where they're just entering new markets. Between 2019 and 2020, 888 Holdings grew at 51%, whereas Super Group only grew at 27%. Flutter grew at 27%. Is this? No, I think I did that wrong. The Flutter grew at 27% in the same scope. It seems like in the future, the expectations are that growth slows down a bit for Flutter and 888 Holdings, whereas Super Group's explodes in relation to those other two. Do I believe that? I'm not sure. Are the 2021 analyst projections for 888 Holdings and Flutter a bit low in relation to Super Group? They seem that way. Why is Super Group growing at 20% plus, whereas Flutter and 888 Holdings are back into the single digits? Is the assumption that 2020 was kind of an off year because so many people were at home and stuck doing nothing, so they gambled online a bit more, and things returned back to normal in 2021, in which case, is this projection that they're going to grow at 36% over last year kind of a BS number? Maybe, right? If that's what analysts project from these other two companies, why would it be different for Super Group, right? They're entering new markets, but is that going to drive such huge revenue growth year over year? If you kind of look at what 888 Holdings was able to do, sure, they're growing their revenue at, did I close it? Whoops. Sure, they're growing their revenue at a 81% clip, but their starting point is only in the 50 to 100 million range, right? So what's going to drive this $400 million revenue boost for Super Group? They're acquiring a new company, but is that company currently generating revenue or is it in a big way, or is it just a small piece of the pie, the overall pie? And is this assumption that they're going to grow revenue at a 30% clip driven by something else? That's the question I have to ask myself as an investor. Clearly, Supergroup has better EBITDA margins. They don't mention anything about free cash flow, but in general, with these other companies, free cash flow conversion is pretty good, right? So they are free cash flow positive for both 888 Holdings and Flutter. I would assume Supergroup to be the same. It's kind of weird that they don't point that out. So maybe that's a concern. You would expect them to say, hey, look at our flash free cash flow EBITDA conversion percentage. It's huge. Why aren't they doing that? I don't know. It seems like an easy win for them in the investor presentation. If I'm an investor, do I love this deal? It's fine. I don't hate it, but it doesn't seem to me like it's a slam dunk deal in relation to some of these other companies. The truth is that American investors right now don't have access to some of these global corporations. Like Flutter trades on the London Stock Exchange. You can buy over the counter, ADR shares of it, but you can't just, go to the New York Stock Exchange and buy shares there, whereas you can of Supergroup. Same with 888 Holdings. There was talk of potentially them having an IPO in the United States to give American investors easier access. Would that increase the valuation of that company? To me, 888 Holdings seems like a similar corporation to Supergroup in terms of, maybe slightly lower EBITDA margin, but historical growth rates were in line, if not better. They're also global. They also have offerings that are just, not just sports betting. It's also casino games, poker, whatever, craps type of online stuff you've got going. So why am I paying, 4.2x sales versus 2.3x sales on 888 Holdings? I don't know. I don't see anything here that is like, wow, this is an amazing deal. Of course, if you compare it against something like DraftKings, which is trading at 30x sales, 4x sales might look really good. But most of their revenue right now is from the global market, right? It's not from the more profitable US market. If they can do a good job of expanding into the US market, then this valuation is certainly worth it. But right now, I haven't seen that. So as an investor, I'm kind of like, yeah, this deal seems fine, but it's not blowing me away. And I think that's kind of why the market reaction is a bit muted. I don't know if the expectations here are unrealistic. I don't think they are, but I am a bit worried by the fact that, hey, for Flutter and 888 Holdings, which are similar companies in terms of what they do, they're global companies that are either somewhat in the United States or just entering the United States. The projections for 21 over 20 are mid-single digit growth, and Supergroup is saying, hey, we're going to grow hugely. We're going to go from growing at 20% between 2020 and 2019, which was a huge boom for all of the other players in this space, to 36% this year. And maybe part of this growth was that, hey, 888 Holdings and Flutter just entered the US markets here, and Supergroup is doing that here. So they'll get a boost from that. So if you believe that's the case, then, maybe this is a decent investment. But at the end of the day, the valuation is fine, and it's not super enticing in relation to some of the other players. One of the things I look at is, does this business just look much better than any other business, and does it warrant a higher valuation? And I don't know if the answer is yes here. They're all EBITDA margin businesses that have decent EBITDA margin. Supergroup's a bit better than 888 Holdings. They're all probably free cash flow positive. They all aren't over indebted. Flutter has a bit more debt than Supergroup or 888 Holdings, and they've certainly got more scale, and they're all priced in a relatively similar range. It's just that Supergroup is expecting to grow a lot faster, and as such, they're garnering a slightly higher multiple than something like 888 Holdings. And if that turns out to be true, then that multiple is fair. But if it doesn't, or if 888 Holdings grows faster than they're projected, then 888 Holdings might be the better deal. So for me, this is this deal seems okay. It's good it's good, easy access to a solid online gambling company, but it's not something that jumps out to me as a must buy right now. If I saw this and all of the other players were closer to what DraftKings is, then yeah, I'd be excited. But all of the other global players are kind of in line with Supergroup. So again, this valuation seems fair. I don't love the deal structure because there's people getting out, there's people ditching, jumping ship, and some of the cash that should have gone to the balance sheet goes to those people. So that kind of sucks. Growth seems overly optimistic in terms of their historical growth. I think they're really depending on the U.S. expansion to be successful. I can see that being true. I don't necessarily think that their 1,500 or 1.5 billion revenue projection for 21 is ridiculous. They obviously already know what's going on in part of 21, so I don't not believe it, but I also somewhat think that some of these other analyst predictions for 21 might be a bit pessimistic. So with that in mind, if I just look at 2020 valuations as the true valuations, Supergroup seems a tad expensive in relation to some of the other guys. Flutter is at 5.6 EV over sales, 24x EV over EBITDA, but they're a bigger company that's more mature. So I understand that. They already have a decent share of the sports betting in the United States or the US gaming share as well. They're investing a lot in growth there. Supergroup is going to have to do a lot of investing to get there, whether it's via acquisition, merger and acquisition, whether it's via marketing spend. They're probably already free cash flow positive, but they're not getting a ton of cash out of this deal. So they're not really getting an easy acquisition out of it that they can drive growth with. And they're going to have to compete with all these other guys who are frothing at the mouth about the prospects of the United States gambling market. And the valuation is sort of in line, right? It's, like I said, it's in the middle of the two players that I'm comparing it against. There's probably other players out there that I didn't compare it against. But the global gambling space kind of drives this sort of valuation. And Supergroup is fairly valued, maybe slightly expensive, unless their growth comes to fruition. If they can really grow at 36% while the other guys are growing at 5% this year, then hey, this is an interesting investment, but we'll have to see that thesis play out. So we'll see. Am I going to buy more of this? No. Am I going to hold what I have? Like I said, I have a bunch of warrants that I bought like at $10 or something when the stock was at $10. So I'm probably slightly in the positive here. I don't know. Maybe. I'm not like super excited about this deal. It's fine. Now that I look at it, it's like, it's fine. Clearly, if you look at it from the perspective of DraftKings or something like that, this seems like a really good deal in terms of multiples, but if you compare it to some of the other global players, it's fine. Honestly, I think I'd probably be more interested in investing in Flutter if it wasn't a pain to do it, simply because they have FanDuel, they have physical sports books, they've gotten a faster start on the U.S. market. The valuation's higher, but it's probably warranted given what they have in place. I think Supergroup's more of a question mark. It's got higher upside than Flutter, but potentially more risk simply because the valuation isn't that far away from them. But they have a lot of catching up to do, and clearly they've done a good job in other countries where they've expanded. But there's a lot more competition in some of these markets that they're expanding into now, especially the United States. And it'll certainly be an interesting couple of years to see what happens with these industries and these online-only players. Now that I think about it, I'll probably just hold on to my warrants, but I'm not going to buy any more. I'm probably not going to convert them to common shares. If they see a bump in the next couple of months, I might jump ship because the valuation just doesn't seem all that exciting to me now that I've taken a deep dive into it. I don't mind it. I don't think it's a bad deal by any means. It's kind of getting us back to SPAC deals that are fairly valued, but fairly valued only gives you, market level upside, right? If this thing is going to return 8 to 9% year over year, where is my upside versus the marketplace? And the answer to that might be, well, this thing's going to grow faster, so it should be valued at a higher multiple. And that's potentially the case, right? And that's probably why I'll hold on to my warrants, because if this thing does end up growing 36% year over year between 21 and 20, and it continues to grow into 22, and it starts making steps into the market, the US marketplace, then the 4x valuation may be too low, considering where the valuations for companies like DraftKings are, right? But DraftKings also has the fantasy sports side of things. Can Supergroup expand into that? There's a lot of question marks here that make me want to have this as a small position versus a large position. So I'll probably hold on to my small warrants position. As always, guys, I'm not a qualified financial advisor, just doing this for fun. Talk to a qualified financial advisor before you make any investment decisions. Thanks for watching, guys. Let me know what you guys think about Supergroup. It's certainly an interesting area to invest in. It just doesn't seem like it's that much better value than some of these other players. So market multiples may expand for all of these guys, and if that's true, you'll do well as a Supergroup investor. If Supergroup does well in the US expansion, then you'll do well as a Supergroup investor. I will hold on to my shares. Like I said, I am long DraftKings, long Supergroup, long SEAH, etc. Thanks for watching, guys. Let me know what you guys think about this company. Certainly a lot of upside here, but at least current market valuation don't make it seem like a slam dunk to me. So that's my take. Let me know if you disagree.